sobering FOMC meeting, Jerome Powell and the Fed just came out hawkish. They have firmly put markets back in the box, telling them that we are not getting the rate cuts we were expecting. What does this mean for the crypto price? We can see Bitcoin here dumping to the downside as the announcement was made and as Jerome Powell was delivering his press conference. What I'm going to do over the next 5 or so minutes is break down exactly what was said and what ramifications this has for the market longer term. If you appreciate these breakdowns, smash up the likes. Do not forget to subscribe. If you actively want to trade with me, check out the link to our Telegram community below. As you can see here, this first line is when the original rate decision was made at 7 p.m. my time. You can see Bitcoin started moving to the downside. You can see even the Nasdaq on the right hand side started falling as well. Then the Nasdaq started recovering. Bitcoin continued to fall. This second vertical line is when Jerome Powell started speaking and Bitcoin continued to dump here to the downside, now giving up a lot of its gains, which we saw earlier in the day. The Nasdaq was a bit of a different story. It dumped originally, it recovered. As Jerome Powell was speaking, it started breaking out as well. But then when Jerome Powell stopped, it kind of just gave back the gains again. So Nasdaq is a little bit confused as well. Overall, the Nasdaq is up 1.3% here today. You can see Bitcoin is up 2% after originally being up 5% on the day. Okay, lots to get into, guys. Let's start off with what happened a couple of hours ago, which was that we got the CPI reading, right? We got the CPI reading, the one that Powell gets just as his team is deliberating what we're going to go through here. And the reading came out as a beat, as far as we're concerned, right? In terms of inflation coming in slightly lower than what the market had expected. It came in at 3.3. Markets were expecting 3.4. Thumbs up, we're getting a rally. Bitcoin went up 5%. Boom. Powerful day, making up for the horrible day we got the day previously, right? So things were looking strong. Markets were rebounding. But then came Jerome Powell. And it wasn't the fact that he decided to pause interest rates. Market were expecting that pause in interest rates, right? Nobody was expecting a rate cut. It was the summary of economic projections, which we're going to get into right now. So let's jump into the summary of economic projections. Let's pop that there. And this is what comes out. And this doesn't come out in every single meeting. No, it doesn't. It doesn't come out with every FOMC meeting. And the last one we got was in March, okay? And I'm going to zoom in and try to explain exactly what the confusion, what the situation was here and why markets were upset. So we'll start off with GDP. GDP in the March reading was 2.1, and they kept that at 2.1. They didn't revise it. Unemployment in March was 4.0, and they kept it at 4.0. They didn't change it. So those weren't the issue. Then we come down to the issue points, which is firstly, take a look at the PCE inflation. It was 2.4. Right? They thought that inflation would come down to 2.4. They revised that to 2.6. In other words, it's not coming back as much as we thought. Core PCE, they did say 2.6, revised it to 2.8. Oh no, it's not coming down as much as we thought. And then this is the biggest problem. It's this one. It's the Fed funds rate by the end of this year. So in the March reading, right, which is this one here, we were led to believe that they assumed we'd be at 4.6% Fed funds rate by the end of this year. And they pretty much had this from the start of the year. And remember, we're currently at 5.25. In other words, what they led us to believe is that we were going to get 3 rate cuts, right? So all the content you've been hearing is that, we're going to get 3 cuts. And markets were really excited for 3 cuts. Now they've changed it, haven't they? They've gone ahead and changed it to 5.1%, which basically means, nope, 1 cut. So what happens to the difference? Hold up. Do you want to learn how to trade? Then you need to jump into our Telegram community. Link is in the description. In our Telegram community, I share my altcoins. I share how I do my trade setups, how I do my stop losses and take profit, so you could learn to become a profitable trader. Check it out. Link is in the description. What happens to the difference between the rate cuts we were expecting and what we're actually getting? Well, guess what? Markets have to recalibrate. Markets were going into this year and the whole first half of this year expecting 3 rate cuts. And markets were being quite sensible, I think, right? Markets, as each month was going on, was kind of unwinding and saying, maybe we're only going to get 2 now. Maybe we're going to get them later in the year. They were kind of adjusting accordingly. And now Jerome Powell and the Fed have come out and said, Those three we kind of half promised you, yeah, you're not getting them. Inflation's kind of proving to be a little bit tricky. This is a little bit of a problem for us. And so this is a really sobering FOMC meeting for us, because it suddenly shows us that, hang on, the job is not done. And this is something I've been alluding to time and time again, that until you break the back of inflation, you could have sticky inflation. And we don't want sticky inflation. Right? We saw that in the Paul Volcker period as well. When you've had steep rate hikes, you then struggle. You do get inflation down quickly, right? You do get it quickly down from, let's say, the 9% up here. You quickly get it down to the 3s and the 4%, but then you struggle. You start getting sticky inflation going sideways for a bit. You're unable to finally get down to the 2% rate, which is that, that almost special rate that the Fed say is our benchmark. We need to get to 2% inflation. I need to feel confident that we're going to get to 2% in order to get those rates cut. So that's what we then faced, and the markets reacted to that. But it doesn't stop there. The markets were also worried by this. This is what's known as a dot plot. This is where every Fed official puts one dot on this chart, like one dot each, right? And they will vote in terms of where they see interest rates by 2024, 2025, 26, and then longer run, okay? Now, previously, in the March projection, the majority of these Fed officials, the median dot, what they call the median dot, the majority in the middle, had expected we would get 3 rate cuts. Right? 3 rate cuts like we went through earlier. Now look, you can see that the median vote is in here. The median vote is in the middle here now to say we're only going to get 2. But here's what's worse. Not only have we lost some of those rate cuts, 1, right? Sorry, this is saying 1 rate cut. I just want to highlight that. That is saying we're going to go here, right? 5 to 5.25 rate range. This range here means 1 rate cut from where we're at right now. So to summarize, what this dot plot is telling you is that 4 officials want no change, right? 7 officials want 1 cut, and 8 officials want 2 cut. In other words, they haven't got a Scooby. They have no idea what they're doing. We have a disjointed Fed, which is a little bit of a problem, isn't it? If the Fed are sitting here towards what should be the start of their pivot moment, and they're all kind of all over the shop. As if that wasn't enough, when you then go into the 25 projection, look at the confusion. You got one hawk sitting here. He's crazy. He thinks even by the end of next year, we shouldn't even get a rate cut. Okay, whatever. Then you got this crazy dove over here. This dove thinks we should get all the way down to kind of 2.75 to 3 by 2025. That's not going to happen either. And so the sensible ones kind of then settle around the middle, which is us getting to here, right? Which is that 4 to 4.25 range. But that's not good enough. That's still not good enough. Again, coming back to this, what they had led us to believe is that we would be at 4.6 by the end of this year. That's not going to happen. We can throw that out of the window. And then they told us we'd be at 3.9 by the end of 2025. Now look, they've revised that as well to 4.1. In other words, they are catching us up, right? Because look, if you look at the differential here is 5. They've revised this up by 0.5, but they've only revised this up 0.2. So what they're saying is you're going to get less rate cuts now, but we'll try our best to catch up down the river next year. But who knows, right? They can just change their mind like they've done now and kind of change their mind in next year itself. So a real sobering kind of FOMC meeting for us, really, to kind of say, you know what? The job isn't done. If you were sitting there doing a victory lap, thinking that rates were, inflation is now done and we're going to get our rate cut, the Fed have just kind of thrown a pooper to our party. And so we're going to have to recalibrate what we're thinking here. And it starts with saying, okay, where are we at with the chart? Now, it's important to not overreact at the same time, right? I know a lot of people are overreacting. I just wanted to make sure that I landed the importance of this FOMC meeting, and now we'll look at the TA. If we look at it from a TA perspective, it's not the end of the world. I mean, we're still managing so far to kind of hold a green candle today. I mean, at one point, this was a huge candle earlier today, right? It was up 5%. This was a big green candle, a bullish engulfing candle, which would have given us the confidence that we could bounce. I mean, if we got a dovish Powell today, what a perfect pattern for us to bounce and go work through to touch all-time highs. But now with that kind of a Powell, markets are going to have to digest this over the next couple of hours. They're going to have to think about it. They're going to have to think about it going into tomorrow. And there is a big risk we could start looking to come back down into support. And again, to reiterate, where's our support? I mean, we got the EMA ribbon. I mean, we may lose it. If we have a red candle today or tomorrow, we could lose our EMA ribbon. That's going to be a little bit of a worry. And support doesn't really start coming in I mean, obviously you got some small support around 64, 65, but then you got your big support coming down here down to 60,000. Again, longer term, I've shared this over the last kind of couple of weeks or so with you guys. The big worry I had was that we never touched that all-time high. When we had the momentum on these weeks here, like 4 weeks ago and last week, we didn't manage to wick above. And so for me, we were already creating what's known as a double top pattern. So I was already preparing myself, like you saw in the previous videos, that we may get a pullback. And if we do get that M pattern, if we do get that playing out, right? Here's your M, boom, boom, M pattern, right? Moving you to the downside, then I will be ready to buy the dip. Right, in this EMA ribbon, starting from 61,000 down the low we want to go, I'll be ready to buy the dip. It could give us more opportunity to accumulate. So Bitcoin now has kind of recalibrated, now just up 1.6% on the day when it was up 5%. But we have to take the positives. The positives is that the market is still green despite that. In other words, what it seems now, and again, I'm going to have to sleep on this and ponder this and give you my updated thoughts tomorrow, but what it seems the market is doing is it's saying that the CPI reading we got, the 3.3 versus the 3.4, is more important than what Jerome Powell just did in the summary of economic projections, which is very, very interesting if you actually read between the lines, because they're saying, you know what, we're focusing on the data. What you're saying, whatever, the data matters, because we know if inflation comes down, then you're going to have to cut rates. The other thing that's going on in my mind, which Jerome Powell said even in his press conference, is like he knows that the labor figures can drop off a cliff at any given time. And so the risk is that if Jerome Powell is being so trigger shy and the Fed are so trigger shy to cut rates, what if they just break something? And that's a big scenario. We've seen Fed officials do this before, where they keep rates so high for so long because everything looks healthy and inflation's still high. But then, boom, suddenly in a month or 2 month or 3 month period, the back of the economy breaks and suddenly they're left scrambling to do a rate cut. And that's what's known as a hard landing. So it may be that we're going to walk into a hard landing. Right, we may just run into this hard landing without actually us thinking, hang on, we should let off the gas a little bit. We should start giving, some rate cuts. And I think one of the journalists asked a really good question towards the end, which was, why didn't you just do one rate cut this summer, just to kind of fill the market? And it was smart how they pitched the question, because they said, why are you doing one rate cut this year? Why have you priced in one rate cut? Does one rate cut even meaningfully make any sense? And he kind of said no. And then the next question was, okay, so then why didn't you just do one in this summer just to see how the market reacts to it? Very good point, right? But he doesn't want to do it. He wants the market to tighten up, and he wants to make sure that the market doesn't get too excited. There's still a job to do to get inflation down, and that's going to pose a little bit of a pause and a little bit of a kind of a concern in terms of some of our crypto investments. So for me, keep it calm. If we get that pullback, I'm going to be DCAing. Nothing, just means more time to accumulate for me. Makes no difference. The volatility is great for trading as well. So make sure you're jumping into our Telegram community, ijazcrypto.com/TG. We will actively be trading, so join us in there. Thanks for watching, and I'll see you in the next one.